Okay, so it's 7:05. We will go ahead and get started. This is our normally Long Beach for investors by investors monthly meeting on the last Thursday of every month that we do. Typically, we meet at the Long Beach Public Library, but due to obvious pandemic concerns, we've been virtual since March. And if you haven't attended a FIBI meeting before, it's all about real estate investment education without the sales pitch. So typically we bring panelists with great level of experience in all kinds of different disciplines, local, out of state, everywhere, in all kinds of different disciplines in real estate investing. And we just have a nice panel discussion. And the audience can learn, ask questions along the way. Feel free to use the chat. Tonight, we're doing a little bit of a different format than usual because we wanted to do a mid-year market update. And judging by the number of RSVPs we got, it's a popular topic. So everyone's wondering where the market is going right now. We're in the middle of the COVID-19 pandemic. People have been guessing at the directions of things, wondering what's going on with real-time data since this really broke out and got serious in March. We've been watching the stock market first plummet, then roar back. Companies have incredible valuations. People are wondering what's happening. Where can you put your money? Where are you going to make good returns? Where's the opportunity? And the story, I think, is different depending on where you're investing and what asset class you're looking in. So tonight, we have a great panel. We have Dave Coe, who a lot of you have probably met, South Bay FIBI leader, and he knows a ton about the residential space in LA markets all over the LA area. We're really focusing on LA County market data tonight. We have Erwin Busey with Paragon Commercial, and he's an operator of retail in high barriers to entry market and does a great job working with some major tenants, big investors, a guy I really admire. And man, being in retail right now, I'm curious to hear what Erwin has to say about what's going on there. I think that's going to be the most interesting part of this talk. And then I'll be covering the multifamily segment of our presentation tonight. My name is Anthony Walker. I am the CEO of Buckingham Investments, which is a local multifamily brokerage company right here in LA. We help people learn, plan, and invest in apartment buildings. And I also have a sizable portfolio of apartments myself, mostly in the Long Beach area. So I have some really detailed knowledge there. And then our company's done a lot of research on the LA area. This is the greater South Bay area. And so we're going to share with you some specific statistics and market data tonight. And unlike our usual FIBI panel presentations, we will show you some actual numbers and do some screen shares. So hopefully we can get all the technology to work and everything, but I figure that's useful for a topic like this. It's hard to just have an anecdotal conversation about where everything is going. So thanks again for joining us. Feel free to enter questions as we go along. We're going to do this one a little bit differently than we do other meetings. Instead of just asking questions and then rotating around the panelists, we'll turn it over to each of us for 20 minutes or so at a time to give everyone kind of a presentation, a rundown on the state of the market in our expertise area. So if you have questions about each area, ask them as we're going along and we can kind of have a longer conversation about that topic while we're in it. So without further ado, we're going to start with Dave Coe and the residential space. And Dave, you have the ability to share your screen whenever you're ready. So go ahead and introduce yourself and let's dive into some numbers.
Will do. Thank you, Anthony. Hey, everyone. So yeah, my name is David Coe, and I am the chapter leader for the South Bay FIBI group. We've been getting together since 2012. So we've had over 200 meetings over the last 8 or 9 years here. And then I'm also one of the partners in FIBI, and getting Anthony on as one of our FIBI chapter leaders is exactly the type of people we like to attract because FIBI is all about sharing information, networking, and not selling anything. And if you're new to FIBI tonight, you'll certainly see that within our presentation. We're just here to give data. And of course, we want to network. So, anyone here that's interested in networking with any of us, please reach out, and we'd love to find time to chat off the call. I've got, kind of two parts to my world. I am a residential agent based out of El Segundo with Keller Williams, and I've got two parts to my team. I've got a resale division, which is primarily focused in South Bay real estate. And I would say kind of our radius that we do is, everything Marina Del Rey, Inglewood, kind of down to San Pedro. We do leak into Long Beach a little bit, but we're primarily Redondo, Torrance, and Hermosa, I'd say, are our core markets. And then I've got part of my team that also is handles exclusively new construction. And I, besides being an agent as an investor, I've got a company that I run with a guy named Brian Miller called Capital Stack Investments. We love investing in LA infill construction, primarily to millennial housing. And actually, when I go through the numbers today, I always like to look at the residential market kind of in everything under that $1.3 million price point, and then everything above that. So I've got some stats, looking at those couple of different price points. Although historically, I'll be honest, I've always said that the lower end of the market was moving a lot faster. But man, I'm telling you, just pulling all these stats in the last couple of days, the higher end of the market is picking up ground quickly. So, residential is hot. And I'm going to go ahead and share my screen here, and I will jump into it. Make sure I've got this. Oh, wow. Can anyone see my screen? Did that disappear here?
Not yet.
Cannot see it yet.
Okay, let me try again. Oh, here we go. Let's try this. It said screen share failed. Let me try again. Okay. Well, we're off to a great start here, aren't we?
Yeah. Having some issues. I thought it was all at my house.
Okay. I think I know why. I think my presentation crashed is what happened here.
Oh.
All right, hang on a quick sec. The good thing is we're all on our computers here. Keynote. Okay. Oh, I see. I'm close.
All panelists definitely have access to share. Thanks, Alex.
You know what I think? I don't know if I can run a presentation and on a screen share. So I may have to just kind of go through the slides and let me try this.
There we go.
How's that look?
We got it.
That's good.
All right, so good. Let me make this a little bit bigger, get rid of this, and I'll just kind of go through the slides individually here. Slide only. Okay. All right, so yeah, we're looking at residential with really looking through the end of June right now. And I need to get from slide to slide here. I'll have to keep that up. All right, so first thing we're going to look at is we're going to look at LA County as a whole, and we're going to look at all property types. So I specifically just did single family condos and townhouses. I didn't do any 2 to 4 because Anthony's really going to kind of jump into the the multifamily space. So looking at closed sales, this is 5 years of data, all of LA County. And the thing that I thought was interesting here is that when you look at just total number of transactions, generally every year, right around January is when we usually have our trough of number of transactions, right? So it always seems to drop, it always seems to drop, it always seems to drop. And then here we go this year in January, it actually was kind of on par with where we were in 2018. And as you can see, it was starting to kind of climb back up here. And then all of a sudden COVID hit, right? So I call this little V right here, the COVID V, and you're going to see this V quite a bit. So at the end of June, in the Los Angeles County single family houses, we sold a total of 4,333 houses, which is 25% lower year over year than last June. But as you can see, we are climbing sharply. And I thought what was interesting is looking at pending sales. you can see that, man, pending sales, this trial down here was actually April. May comes up here over 4,000, and now we're in June, end of June, and it's over 5,000, almost 5,100 pending sales. So a lot of deals are dropping into escrow right now. When we look at active listings, over the entire county, you can see there's 13,000 active listings right now. And really it's kind of flat here, but I think what you're seeing is that, you know, I've got two charts here. The one down below, this is all new listings. Okay. So this is how many listings came out in the month versus this chart above. This is how many total active listings there were in the month. And you can see that the listings are just climbing super fast here in June, over 7,500, down from less than 5,000 just a couple of months ago. So people are kind of coming back in, starting to trust the market a little bit. You know, obviously showing houses these days has been it's a much different process than it used to be. We can no longer have open houses. Anyone that wants to come into a property, they have to have a scheduled appointment. You have to sign a disclosure. It's called a PEAD form, P-E-A-D, which is basically a coronavirus advisory form that lets you know coronavirus is out there and you're taking risk. So, you know, especially in, you know, when the virus first hit in March and then April, really everything just kind of stopped. It didn't go up. It didn't go down. It just stopped. There were no sales. There were no showings. And then as you start getting back into May, we start getting some rules and regulations. And, you know, as a residential agent, we've got to be worried about the state of California, the county of Los Angeles, the city of LA or Redondo or Long Beach or whatever city we're in, as well as we've got rules and regulations with CAR, you know, the California Association of Realtors, as well as our broker. So everything, we've got 6 different kind of rules and regulations that we're up against. But all that being said, buyers are out there. And as you're going to see right here, with, you know, pending sales are up, new listings are going up. The market is recovering here at a really quick pace. You know, one of the things that we like to look at is month supply. That's usually a key factor. And you can see really for the last 5 years, you know, we've actually been on the lower side of month supply. Historically, when you look at 6 months of residential housing, that's considered a balanced market, right? Anything below that is considered a seller's market. Anything above that is considered a buyer's market. And we have been well below that 6-month figure for a long time. In fact, even before the virus hit, you know, we've been kind of stalling in prices, but it hasn't been because of a lack of buyer demand. It's actually been a lack of seller supply. And we have been in a supply challenge market long before COVID hit, which is keeping months supply down. You know, you see it really drop down, you know, almost a 2 months of supply back here in April and May. And really what that was just no one was putting their house on the market. And now all of a sudden it's rising again, but that's just because we've got all these new listings. I think over the next month or two, this is going to take a dramatic turn down just based on how many pending sales we have across the county. And then median days on market is another one. You know, even, you know, 5 years ago, we were up and around 50, 60 days on market, which still is pretty good. Getting your house sold within 2 months is pretty good timeline. And then look what happens in 2017, 2018. I mean, you put a house on the market and, you know, 12 days later, you've got, you know, 5 offers on it. That's been pretty common in the market. It actually dropped down to less than 10 days in April, which again, I think is just more an anomaly of there wasn't anything. So anything that did get posted actually got snatched up pretty quick. And now we're kind of, you know, moving back up a little bit, but we're still under 30 days on market for residential across the county, which is super low. And the effect that you would think that would have on pricing, it is. When we look at median pricing, and this is looking back for 5 years, you can see that we have just been slowly climbing. And where you might expect to see a big dip somewhere here, you didn't have it. And again, because we didn't really have any transactions during that time frame, right? So it wasn't like a bunch of people got, you know, scared and dropped their prices and A bunch of investors came in and bought it up. It just kind of stayed steady. And then here we go. We're continuing to climb. And then when you look at the number of pending sales, just the days availability of properties for sale, and you look at the days on market, the general thinking is, at least for the rest of this year, that prices are going to continue to climb in the residential market. The next thing I did is I wanted to kind of take a look at the LA metro area. And the best way I thought about pulling these stats is, we've got 3 main realtor associations in the area. Obviously, the South Bay covers, pretty much, everything in the South Bay. Beverly Hills, Greater LA kind of covers everything from the west side to downtown. And then Pacific West, which is actually located in Orange County, covers Long Beach and kind of Seal Beach, Huntington Beach, all of that part of Orange County. So when I think of the LA metro, when I actually looked at the numbers, this is about 60% of all of the sales that happen in LA County happen within these 3 associations. So looking at closed sales in the South Bay, you can see we had 350 closed sales in the month of June. And it looked like the lowest it got was right around that kind of 250, 275 mark in May. And that was because we didn't really have anything that went into escrow in March and April, right? So this is probably our trial. And you can see for all 3 areas, this seems to be where we have the low point on actual number of transactions, but everything is climbing quickly. When you look at pending sales in all three markets have a radical increase in pending sales month over month. Yet you can see for most, we're still down year over year from where we were last June. Same thing with closed sales. South Bay is down about 15%. Long Beach is down about 16%, and Beverly Hills, Greater LA is down about 27%. But we're trending up. When I look at listings, kind of the same thing has happened. The one thing I thought was interesting is that in looking at Pacific West, which again is kind of Long Beach and North Orange County, it's actually pretty flat. So what that tells me is that every new listing that's coming out, someone's buying it pretty quickly. So there's not a lot of active inventory that's building up. Although we do have a little bit that's starting to build up in kind of the Beverly Hills, Greater LA. And when we start looking at some of this data, when it's carved out by price point, I think you'll see kind of, most of that's happening in the upper end of the market, not the lower end of the market. And the South Bay, it's been pretty consistent for a number of active listings. So, I think you got a little more seasonality that you see in some of these other markets, but the South Bay tends to stay right around 1,000 active listings, and it has for almost 5 years. And actually, I looked at this one even further back, almost for the last 8 years, you've got, a pretty, right around plus or minus, 15, 20% number of listings in the South Bay. New listings, again, you can see seasonality. Most people in December don't want to put their house on the market. They don't want to have people coming in when you've got family, you've got Christmas presents, and you've just got travel plans and everything else. So there's always a peak. And again, you can see we kind of went down, we were starting to come back, and here's our COVID V right here, right? So all 3 areas, you see that there's this drop. What I'm curious about, for me as the market goes on, you can see how consistent it's been almost in all 3 regions on how many active listings there's been year over year over year in these. And here we are, we almost reached these December levels in April, but now we are climbing back up. The general feeling that I have on the market is usually, this is our selling season right through here, right? This kind of, February through July, and then things kind of start to tail off. Usually the second half of the year, school's out, families are traveling, you just don't have as many buyers out there. And then you kind of, it slowly starts to recede until the end of the year. Well, this year, what we're kind of projecting is that when you look out, no one's going to Europe. Everyone's canceled their plans to Thailand. If anything, we're taking car trips. There's not going to be a lot of travel. So our guess is that a lot of this kind of spring selling season that we would normally get in the first half of the year, that this year we're going to get in the middle part of the year. And, my general feeling is I think we're going to continue to have strong economic tailwinds, at least until the election. So I can see single family sales continuing to chug along. And my guess is as time goes on, and just from what I'm seeing in the marketplace, we're going to continue to have strong markets here over the next, I'll say, probably 4 to 6 months. Looking at months of supply, when you get up to, this is the Beverly Hills area, their supply is starting to grow a little bit. But again, this could be a bit of an anomaly just because of the amount of listings that just got listed here in the last 30 to 45 days. But the South Bay and Pacific West, those are still well below 3%. And days on market have just been gradually trending. Although you can see that it kind of was reducing, and things have actually been pretty level since early 2017 in all three of these markets that I'm tracking here. And last but not least is pricing. Median sales prices, Beverly Hills, LA, you can see they're well over $1 million for that entire association versus Pacific West, which, does include a lot of, like Santa Ana and Cerritos and some of those areas as well. They're down about 625, but they're up 5% year over year from last year. Beverly Hills is up 7.5% median year over year, and the South Bay is up, almost 1% at 755. So with everything we've been having to deal with COVID, so far pricing has not been impacted at all. And then I pulled a couple of slides, again, looking at everything kind of under that 1.3 number and then above the 1.3 number. Believe it or not, 1.3 million is kind of the top end of a first-time homebuyer price, which still blows my mind considering I bought my first house for $120,000. But you've got a lot of people out there that are, young millennials are, millennials are about 45% of the home buying segment right now across the United States. Dual income, professional people, putting 10% down on a loan and having high incomes to cover a really high mortgage payment is very common these days. So looking at some of these same stats, this is just on median sales price. And I thought what was interesting here is that when you look at everything, so the top part is under the 1.3, the bottom part is over the 1.3, and this will be for these next couple of slides. Everything in the under $1 million is continuing to rise in all three of these individual association sub areas. So Beverly Hills, Greater LA, they're down 2.6 year over year, but you can just see the trend over the last 5 years. Prices are still going up. South Bay is actually up 2.4%. And Pacific West is up 4.1%. And again, everything's kind of trending up. But when you look at the $1.3 million level and up, this market, all of these three of these markets have been moving flat for almost 5 years now, right? So I think since 2015, people have been claiming, gloom and doom for years now about the residential market's about to crash and it can't last forever. And in some instances, I think, you're right. When you look at this upper end, and even the South Bay, there's these weird months that we have probably when some realtor got lucky and closed a deal on the Strand and it threw off the averages for that particular month. But for the most part, it's been pretty flat in that over that $1.3 million level. Yet the lower end of the market kind of continues to rise. And again, I think that's driven by millennials. They're buying most of the inventory and continuing to push prices up in that first-time homebuyer segment. Looking at active listings, there are, again, things are in the Pacific West region. It's pretty flat, but I think that's more driven by the fact that the listings they did have, they had a lot of sales underneath that. So the active listings are staying pretty flat for the last 4 or 5 months through here. And overall, this is trending down. There are less of this kind of lower end property happening. And really, you can say it's pretty flat across all three of these different sub areas. Except when you get up here, what you're having is in the Beverly Hills, this is everything 1.3 and higher. You can just see there's been more and more listings. So part of that's driven by the fact that prices have been somewhat rising, I think, in the lower part of that. So that $2 million to $2.5 million range. And there's just a lot of new construction happening. And, we just have a lot of active listings. I think this is somewhat indicative of a market that is probably ready to, again, with listings going up, I think the amount of pending sales are going to somewhat cool down. I wouldn't be surprised to see some price decline in the next year happening in this 1.3 million segment in this particular area. But so far, Pacific West and South Bay are, even at the higher end, they seem to be pretty flat. No major variations. And then looking at closed sales, it's again, mostly seasonality. You've got your little, this was kind of where we were. And instead of going up here, we've got our COVID Vs here, but this part seems to be closing. So similar number of transactions closing in that sub 1.3 area. And then when you look at the upper level, which is a lot of where Beverly Hills, Greater LA is, again, it's been pretty consistent. A little seasonality, but for the most part, everything for the last 5 years has been pretty consistent. Pending sales are peaking in all of these, right? So everything sub 1.3, everything plus 1.3. This one really surprised me. I was surprised to see this big of a jump in this market. And I think what's happening is that you probably just have some inventory that was building up. And now a lot of people are rushing into the market, looking to find a deal. And, in the lower end of the market, we've been in multiple offer situations, but I think in the upper end, it's not quite as hot, right? So I think some people that maybe have been priced out or more importantly, they were tired of competing for the last 3 or 4 years. They're now looking at this as an opportunity. But we've got a lot of pending sales happening. And again, we've got all 3 of these markets are trending upwards from pending sales. Days on market are decreasing, all 3, as are median days on market, right? So really, my expectation going into this is that we would see almost a tale of 2 markets, but really, the upper end and the lower end so far have been pretty consistent. So if you're looking at fixing and flipping, I think, whether you're looking at first-time home buyers or you're looking at maybe at higher-end flips, I don't think there's strong market support to lead you one way or the other. I think you're really just looking for a deal. We're building in the lower end. We just feel more confident in this, kind of that sub 1.3 market. But right now there's strong support in these 3 sub areas for both the higher end and the lower end. And then the last thing I did is I wanted to take a look at distress sales. And for distress sales, I had to go back. I went back almost 10 years, so 2008. Now these are all sales, all different types of property types. So single family, condos, manufactured homes, and townhouses. And you can just look at the number of volume, and we've slowly been kind of creeping up, the peak being right around 2017. And then the number of transactions started to decline. But again, most of this wasn't a buyer, something where buyers were causing it. This was more of a seller supply issue. We just didn't have the amount of inventory, so numbers were starting to go down. But when I look at REOs and short sales, you can see obviously the top graph are REOs, the bottom graph are short sales. And, 2008, 2009, man, this was where the party was. If you were buying all kinds of distress inventory, slowly started to come down, kind of flattened out. And I remember in January in 2012, I had a listing that came out and I got 7 offers on it. And I didn't know what was happening in the world. And really what was happening is that was really when the recovery started. And all of a sudden, all of this distressed inventory just falls off the cliff, right? All that shadow inventory that everyone was predicting was going to come in and continue to collapse the market, it just never really materialized, because at that point, we finally hit a point where the pricing of homes was starting to bail some people out. So when prices were dropping in 2008 and 2009, as prices started coming back in 2012, you just didn't have the same amount of distress. And when we look at this over the last, in LA County, we've had 16 REOs in June, and there were 24 short sales in June. So when you're really going to start seeing, I think, opportunity as an investor is when you start seeing these graphs start to climb. But as of right now, we're mostly still looking at a fairly standard sale market. So that's what I've got. Would love to take any questions that are out there if anyone has questions.
Awesome. Great info, David. So I'll ask the most obvious question that I'm sure everybody's wondering. What do you see happening over the next 12 months?
So, again, I think that we're going to be in a fairly strong real estate sales market over the next 6 months. And I think, we've got another round of potential bailout coming, here. I know they're discussing extending the unemployment. I've heard that there might even be, looking at extending some of the SBA loans and just all that, as we're having restrictions on things opening, there's more money coming in. I just think until the election happens, things are going to stay pretty steady. Once the election is over, and I don't think it matters who wins, but once we're past that, and then I think by then we're also going to be looking at maybe having a vaccine. Because all the science we're seeing right now, it looks like end of the year, which means that all of a sudden, if there were moratoriums on evictions, if there were moratoriums on foreclosures, all of that stuff will probably lift, and then we are going to have the reality of high unemployment, a lot of service industry people that are still going to be out of work. They won't be getting the high benefits that they have, and that's where I think you're going to start seeing more distress. I saw a stat last month that 1/3 of all mortgage payments in the month of May were either forbeared or were not paid. Now, some of that's probably strategic forbearance, because if you call up your bank and say, I've got a COVID-related issue, I can't pay, they don't even question you. They just, they just let you out of that payment. And some of those payments will probably get made up as people come back to work. But I think that the market is going to start to correct next year at a residential standpoint. So I've got at least 3 buyers or 3 sellers right now that are saying, look, if I'm going to sell, and all 3 people are relocating either outside of LA, outside of California, or downsizing into something smaller, they're looking at right now might be the time for me to get the highest dollar I'm going to get for my home in maybe the next 3 to 4 years. I've got 2 people that are selling and renting and waiting to see what happens in the next couple of years to buy back in. And, from most of the investors that I'm working with, fixing and flipping, a lot of those guys, unless you can really find a screaming deal, from someone who doesn't understand their market value, or the house is just extremely distressed, it's not a good fix and flip market yet. But I think next year is where you're going to start seeing more of that opportunity. I don't think it's going to be this year.
Okay, interesting. If any of the attendees have questions for Dave before we move on, we can always come back to him later, but feel free to put that into the chat.
Hey, Dave, couple questions for me. How's foreign capital activity in that sector, and what about debt availability as well?
So the first one, we don't have a lot of foreign money down here in the South Bay or in, kind of that Long Beach, Orange County corridor. Maybe you get down to Laguna. You get a lot more of that up in Beverly Hills, that kind of area, the Hollywood Hills area. We saw, when I first saw that stuff, because we were doing some high-end fixing and flipping up in the Hollywood Hills, 2014, 2015. And we had one of our listings where I think over like a 1 month period, we had 30 showings, and 23 of the people that showed it were people that were outside of the United States, right? So there was all kinds of foreign money. Sure. And then that money just like dried up and went off a cliff. So when we were looking at the higher end sales and how they've been kind of flat, I equate that to the fact that a lot of the foreign money, I think, has kind of pulled out of the market. I don't have anything to prove that, but that's kind of my general sense. For the stuff that we're selling out here in North Hollywood, we've got 27 units, and we've got 1 right now that's a foreign buyer. The other, there's 19 of them that are in escrow. The other 18 are local people. So we're just not seeing a lot of foreign money right now. The second question you asked me was on lending. And, you're kind of seeing first of all, rates are incredibly low, right? Like, you're seeing ads for 2.5%, high twos, 30-year fixed rates. I mean, just incredibly low. Lending did certainly tighten up. One of the biggest things was Wells Fargo pulled out of all their correspondent lending. And what I've been hearing from lenders is that while they've tightened up some of their criteria on the lending side, there's also been a huge influx of refinances. So a lot of people that all of a sudden saw, rates drop below 3%. I've got someone I talked to a couple days ago who just bought 2 years ago, and he's already refinanced 3 times because rates just keep going down and going down and going down.
Yeah.
So there's tons of available capital. If you've got a job that's COVID infected, everything we're doing up in North Hollywood has a lot of the entertainment industry. And of course, a lot of those industries are already weird because you work for 13 weeks and then you get fired and you start another job, and lenders always have a hard time because they don't have consistent income. But some of those people aren't back to work yet. They're either, on some kind of furlough. So I think it's going to hit different industries a little bit different, but generally there's capital available out there as long as you've got a good job. And I have the feeling the two of you will probably have, stories about more constrained capital markets than we're seeing on the residential side.
Yep.
Awesome. All right. Well, if anyone thinks of other questions for Dave, feel free to put them in the chat, or we can circle back around and do that later as well. I am going to jump into the multifamily segment now. Very exciting conservative real estate. So let me start here. If you haven't looked at multifamily data before and you're not sure what it is, we've got a handful of metrics that we always look at that you need to understand in order to make sense of this stuff. So obviously you have the price per square foot, which is similar to what you would see in single family, and price per door or price per unit, as a lot of people like to discuss. But then you have the gross rent multiplier, which is the GRM, and also the cap rate. And so those are kind of two sides of the same coin, but those are income metrics for valuing property, because multifamily property is really valued based on the income that they produce. The GRM, the formula for that is just the purchase price or the sales price of a property divided by the gross scheduled rents for the year. So if you had a rent roll multiplied by 12, that's the denominator of that equation. That sounds a little bit confusing, rattling off the tongue without looking at something on a board, but an easier way to think about it is it's the price you're paying for every dollar of annual rent revenue. So here's our 2020 second quarter Greater South Bay market study. And you can see the price you're paying for every dollar of annual rent revenue in each of these cities. And so typically the nicer, more desirable cities are going to be more expensive to buy in. So let's see, Manhattan Beach is a common offender. 22.3 times gross. You're paying $22.30 for every dollar of annual rent revenue for Manhattan Beach multifamily. Harbor City is an anomaly. There was one sale there. I'm guessing that was way under market on rents in a rent-controlled property. But Hermosa 22.6, Redondo 18. They're pretty high. And then you have some of these other areas that are they have a little bit more low-income population, working class, and they're cheaper. So generally, the lower the GRM, the higher the cash flow, and you're trying to buy stuff for as low on the GRM as you can relative to the area that you're in. The cap rate is the opposite. The higher the cap rate, the more cash flow. The cap rate is the net operating income the property generates. So that's the net income before paying any mortgage payments. So it's gross scheduled rents minus all of your expenses, property management, property taxes, insurance, all that kind of stuff. And so this is like the yield on the purchase price of the building. And cap rates often are discussed in the multifamily and commercial space. The higher the cap rate, the higher the cash flow. This would be your cash flow if you bought the building all cash. And generally, the higher the cap rate, the more risk too. So Southern California has very low cap rates compared to people that are used to looking at out-of-state deals, because we have an incredible constraint on supply here. Everybody wants to live in Southern California, and we have a really productive, diverse economy. So cap rates are really low in Southern California in general. Now, these numbers are just a snapshot for what we see. We're gonna look at some trends in a minute, but generally speaking, you need to get down to about 13 times gross for an apartment building to pay for itself with 25% down, where interest rates are about right now. So if you're looking for a general rule of thumb and you're thinking about investing in any of these markets, this is sort of where stuff is. The other thing that we see over on this side is the market is segmented into 2 to 4 units to buy them. So the capital is readily available. It's the same lending that Dave was just talking about. It's mostly resold to Fannie and Freddie. It's 30-year fixed money. There's no prepayments. Real simple, just like a home loan. And 2 to 4 unit properties tend to be more expensive than 5 and up, because 5 and up, you have to pay extra fees. You get a commercial loan. You know, loan dollars are determined by the building's ability to service the debt. So the GRM and the cap rate are going to determine how much you can get a loan for. And people love that 30-year fixed money. So here we are, and they're usually about a multiple off. This is pretty normal between the 5 and up space and the 2 to 4 space. What's not normal about this, and to Dave's earlier point about the lending environment changing, is usually the 5 and up space has maybe a third, you know, of the volume, you know, maybe even 40% of the volume in a quarter. Sales volume in 5 and up now over this last quarter was 24 sales total in all of these cities. Total. There's a very small number of sales, whereas 2 to 4 units that are still lending and haven't frozen anything had 115 sales. So this is really a good illustration of what happened to financing in the commercial real estate industry over the last few months. A lot of lenders froze financing completely, and things have been dicey. They're all starting to come back in right now, and rates have gotten much better. So we're all excited about that, but reserve requirements are higher. There's all kinds of stuff going on in multifamily lending, which we had a event on a couple months ago. So now I'm going to go into where we are, because this is more useful with trends. So I'm going to go back to the beginning of kind of this recovery cycle in 2013, and we're going to look at trends on each of these. We started keeping track of monthly numbers rather than quarterly numbers right in 2020, because everybody wants up to the minute data right now. We're wondering, is this changing month by month? Because we really don't know. We're in uncharted territory, right? Are tenants paying this month? Are they not paying next month? What's going on? And so I'm just going to go through each one. So here are the number of sales. So this is sales volume. Here's sales volume going back to Q4 2013, in case this is difficult to read. And it's kind of seasonal, bounces around, but overall very typical until COVID. And here we are, really dropped dramatically. Normally at this time of year, we'd be going up and we'd be seeing these Q2 and seasonal as a single family market, but it definitely is. People finish their taxes. They've got time to look at stuff. They're not worried about the holidays. We have some, you know, more volume in the spring and summer, and we just went off a cliff. So we're at a very low sales volume in the second quarter, first and second quarter. However, monthly numbers tell an interesting story. We went down, but it's starting to recover. And I think this is basically, we're seeing the lenders come back in. Everyone froze their financing here. Nobody knew what was happening. Now rates are super low. A lot of lenders are jumping back in, reducing reserve requirements. We were at a walkthrough today, and our property manager said he just got an LOI on his multifamily refi, and I think he said 3.35, which is ridiculously low for a 5 and up multifamily refinance. Inventory is also interesting here. So Dave went over this as well in the single family space. Inventory has been low this entire cycle in multifamily. It's been hard to find deals. People like properties, rents have been going up like crazy. A lot of people like to refi and buy, some exchange and move up as well. And inventory has been especially constrained, even going back to the beginning of 2019. It's just been super low. You would expect, if it seemed like the market was going off a cliff, that inventory would be a great leading indicator to look at in apartment buildings to give you an idea of where prices might be moving in the future. And we have not really seen inventory spike at all. I think some of that are sellers waiting, pulling buildings off the market, seeing what's going to happen. But on the other hand, there is still demand as well. So here we are with the monthly numbers on inventory going back to January. This is a pretty tight range right here, just between 290 and 320 listings at any point. And this is in those same cities. This is from about Inglewood down through Long Beach. Dollar volume on inventory, similar story. So then we get into the income metrics. So here's the GRM, and maybe I can make this a little larger. So GRM quarter by quarter, we have this gradual increase in GRM going back to 2013 across this whole market. And the GRMs are really sensitive numbers. So if you think about like a building's annual rents are 100 grand, which is not a huge bill. Pull on GRM that the market goes up, the building's value goes up by 100 grand because you've got another multiple of the annual rents. So going back to 2013, things were pretty cheap. We went all the way up to about 18, and we have had basically a flat, slightly declining market in multifamily in our area since early 2018. So kind of continuing right now. A lot of people, again, thought this was going to go off a cliff and things were going to get super cheap, and there would be distressed sales in the multifamily space where people aren't collecting rents, and it's getting very difficult to run your buildings, and you have to strategically unload things. And that has not really happened. It's still been basically flat. It's gotten a little bit better price-wise throughout 2018 and 19, but it's happening really slowly. Things are not going off a cliff. And here we are in 2020. We're actually up from where we were in January. You know, it looks like kind of a normal market for GRM. So that's interesting. Cap rate is going to look very similar. So again, cap rates are the inverse of the GRM. The lower they go, the higher the prices are. And you see the same thing with cap rates going back to 2013, coming down to just above 4% across the market in Q2 2020, but basically flat since the beginning of 2018. And this is kind of, I wouldn't even call this exactly statistically significant. A cap rate ranging from 3.9 to 4.3. You could probably explain those with a few sales in different cities here or there, quarter by quarter. So it has not been a story of the prices suddenly changing. In fact, 2018 was that lull kind of made sense. Rates kind of went up. The Fed started to increase rates there. And so the leveling off made sense at that point. But then they decided to call that off. And now, of course, we're way back down and rates are incredibly low. So I'm seeing a lot more demand from clients, from people coming into the brokerage and wanting to buy. We're seeing multiple offers on property again. And remember that inventory is super low. So for what is out there, there's not a whole lot to choose from. And capital's so cheap that these yields look really attractive. If you can borrow money in the threes, and these are overall averages, you can buy buildings in the high fours and even fives right now in some of the investment markets that we're in. That's pretty good arbitrage. That's kind of standard for what you would expect as a spread between your cost of funds and your cap rate across this cycle. Pretty tight, but you can definitely make money borrowing like that. Comparing this to price per square foot is kind of interesting. So price per square foot goes back to 2013 here at $250. We've had some fluctuations, and then again, basically flat coming back here from 18, but it's been going up. Fact, we're stabilized, rents got to market, and now you've got buildings that are being sold where the income is really strong and the cap rate looks good and the GRM looks good, but they're able to command a higher price per square foot. So we've actually seen appreciation in the market in that respect because those buildings have kind of come back for sale, and you can go out and buy those right now. Those deals have changed a lot. The value add deal of a few years ago where you buy a building And, you know, a lot of people would even clear it out entirely or raise the rents by 20, 30% in one increase is much more difficult now. It's still possible, it's more expensive, but generally a value add deal these days in AB 1482 world, which is the statewide rent control, looks more like buying properties with a decent upside, taking your maximum increase and kind of slowly riding that up and adding your value over the span of a few years. And look at this, price per square foot, even in 2020, continuing to go up. Surprising for a lot of people. See if I have any charts on the right of this. No, I don't. Price per unit, similar story to price per square foot. And the same relationship between price per unit and the income metrics exists there. You can get a better price per unit if you're commanding strong rents, and the rent growth has definitely been the story of this cycle. Price per unit monthly, same thing. So natural next question to this is, well, what's happening to rents, right? Well, the rents are really interesting so far. We thought when this first broke out, everyone was freaking out. I was adding up my total mortgage payments for the month and wondering if I was going to be covering that myself in the buildings that I own. People were freaking out. We were wondering what sort of relief measures were available. And here is collections data from one of our property management partners that manages over 2,200 units in Southern LA County since the beginning of 2020. And look at this. This is through the 5th of the month in this column, and this is through the end of the month. And he just sent me these real quick today. 86% collected in January. So these January and February are kind of normal months. Look what happens. COVID hits, 83% went down a little bit, but by the end of the month, 95% plus collections by the end of every month, despite being in the pandemic, despite the stay-at-home order, despite most of our tenants honestly being in that kind of service industry type business. Those are many of the tenants that we're dealing with. They are able to make the rent. And we think that's a combination of some of the PPP money, extended unemployment, ability to work from home, and a variety of things. But we've been very, very pleasantly surprised, to say the least, about the ability to collect rent in the pandemic. And my understanding is that this has actually been the case all over the country. So whatever is happening out there right now, it is working. The big debate is what happens moving forward, right? So we're talking about extending a lot of these and relief measures and trying to get the economy back on its feet so that these rent payments can continue to happen. But this has been a really good story. And I think this is the fundamentals behind why you're seeing lenders coming back in and be comfortable, and why the valuations are still looking good. A lot of people are employed. We're going through units, and people are working from homes and from their home. And even in small apartment units, people have got their double screen set up in the kitchen table and they're doing their thing. So this has been a really good story. And there's been a lot of demand for this. We've got people calling us nonstop to get into multifamily because the hypothesis is everyone needs a place to live. Looking at LA, we recently expanded our company's research to LA. And I don't have the trend charts for that, but I have some broader charts I can show you in a minute. We do our research a little bit differently than CoStar, which is the main data source for this stuff. CoStar just calls brokers on deals and asks them what the cap rate was over the phone, which is not particularly useful. So a lot of people just look at kind of price per door and price per square foot on those. We actually recalculate the rents and correct all the listings from the MLS source data, and we publish this. So the whole LA market, and here's the entire city of LA expanded, was at 15 times gross in Q2 2020, 508 sales. And it's similar to what we saw in the South Bay. Your average quarter, Q1, which is even a slow quarter in a lot of years, 816 sales in Q1, 15.8 times gross. And sure enough, the volume way down. Q2 should be a busy quarter for sales in LA. GRM has gotten a little cheaper, but not a ton. Cap rate 2. And this is where the numbers stand. And now, of course, you can see markets that you would expect to be expensive are still expensive. Venice, Santa Monica, over 20 times gross. Playa del Rey. City of Los Angeles is a diverse basket, but you can see that there's still pretty good metrics. A lot of volume in South LA and the downtown area. These are really good numbers. So if you're looking in LA, these are excellent markets to pay attention to. There's good volume there. There's good pricing metrics on income. Really low price per square foot here. This is all rent controlled, so you have to deal with Los Angeles rent control, which is more strict than the California version. So you got to know what that is and how to navigate around that. But there's transactions happening, and they look pretty good. If we split out different areas, San Gabriel Valley, almost 18, pretty expensive. San Fernando Valley, a little better deal, 14.4 times gross. Gateway cities, these are like your eastern suburbs, 15 times gross. Those are good markets to be involved in. And then you have Northeast, 14.7. These are pretty good markets to be involved in. Lots of gentrification going on right here. It's kind of northeast of downtown LA. South LA, Central LA, definitely highest cap rates, lowest GRMs here. If you're looking for cash flow in LA, this is a great place to look. Lots of volume here. And then of course the West Side, the usual offender for the expensive markets. Here we are. I did see a question in there about sharing all this stuff. We're happy to send these charts out. If you shoot us an email, I will enter my email after I'm done talking here. And we also have this available for download on our website. The PDFs are available for download. The Excel versions, you want to shoot us an email if you want to get the Excel versions. But we spend, our analyst, Malcolm, I got to give him a shout out. I know he's on the meeting, spends hours and hours and hours every quarter compiling this stuff and combing through this data. So thank you, Malcolm. Great job. And everybody can, use this data as you see fit. Looking on broader trends, here's 54 years of price per square foot in the greater South Bay. So this is the area where our company's been doing business since 1963. And we're fortunate enough to have boxes of old MLS books and stuff in our El Segundo office that we've kept over the years. And this is price per square foot on 2 units and above going back to 1965. So for those of you who've worked with us before, you've probably seen this. But this is really interesting. And if you go back to 65, we had 14 bucks a square foot. The end of 29, we were at 398. Price per square foot is a good metric to measure kind of long-term overall appreciation in a market. But it's a big question on where we're going in the future. Our 54-year average rate of appreciation, 6.4% every single year. If you just averaged it out from 65 from 2019 and you did a percent change every year. This is why people buy Southern California real estate. You apply a little leverage to this, buy with 25% down, multiply that number times 4, add your cash flow on for icing on the cake, and you're in your 20% plus ROE on an annual basis, no problem. But you got to look at the patterns in this chart to kind of see what's underlying and guess what might be coming in the future. There's about 5 business cycles on here. You notice every time that we, have a top in the market, we have a downturn, we come back, we always surpass a previous high. So that can kind of give us a good idea for what maybe the floor worst case scenario is. I was having this conversation with an investor the other day. Here's our previous high from the subprime boom at 329. So maybe worst case scenario would be all the way down here if people think that there's a wave of evictions and non-paying tenants going into next year once the stimulus measures wear out. I personally don't think that's going to happen, and I'll explain why in a minute. But this cycle was not out of the ordinary. The scale of the chart is a little bit deceiving because it's not on a percentage change, and you have to think about some of these past cycles. This looks like a bigger boom and a bigger bust than previous cycles. That's not necessarily true. Come back to the 1970s, and this is maybe the most interesting cycle for what might be coming in the future. In 1971, we were at $17 a square foot. And in 1981, we were at $86 a square foot. That's a 406% increase in price, which is way bigger than 114 to 329. That's less than 300%, and certainly larger than 205 to 398. That's less than 100%. So this was crazy. And if I don't know if too many people were around investing back then or if you read the news articles, but what was going on at this point in time was runaway inflation in our economy, right? And interest rates got up to 20% or so to try and get it under control. This is what happens when runaway inflation hits a real estate market. If you're borrowing funds around here, then the relative value of your loan up here is almost nothing. So this is a great case study for what might happen, and a lot of people think this is going to happen after this trillions and trillions of dollars of money we're pumping into the economy. I don't think it's going to happen in the next 12 months, but this could very well, we could have a repeat performance of something like this extending over the next 5, 10 years if inflation really comes back in force. And these low rate loans right now, if you can lock them in long run, and the prices that you're paying for buildings right now could look ridiculous a few years from now. So real estate, and it doesn't matter the asset class, real estate's an incredible hedge against inflation if you look back that far. Looking through some of the other trends in this chart, because I always like to talk about this, there's not a one-to-one correlation here with the economy in general or the stock market. Common misconception with real estate markets is that they move in tandem with the economy or the stock market. We're missing a cycle here entirely, right? 2001, we had a pretty good recession. We had the dot-com crash. We had 9/11, and the market just kept going up and up and up. We had one down year in 2004. I think that's kind of a statistical anomaly here. So this really didn't affect the real estate market at all. And it's an interesting case study to see that it's not necessarily a one-to-one correlation. Also, every downturn doesn't look like 2008. 2008 was definitely a real estate-led crash. It was a global financial crisis. It was our fault, so to speak, right? So there were all these loans out there that were never going to be able to be repaid. Property values went crazy, and it corrected the way it needed to correct. You see a more typical downturns in the past, and they don't look anything like that. What happens in the future? And it's anybody's guess, and I'm sure that'll be the first question. There's kind of two sides to that idea, right? So a lot of people think, and I see it in the Q&A, that, well, once the unemployment extensions and extra money and PPP money wears out, then we're really going to feel the full brunt of the unemployment in this country. And that's when we're going to see rents go down. We're going to see prices go down. We're going to see, valuations go down. We're going to see distressed sales. And although those factors are definitely at play, I think it's more likely that we have to look at where yield can be had right now across any asset class. So if we're in here and we're looking at cap rates, even in a really low cap rate market like Southern California, and a low cap rate asset class like multifamily, and we have interest rates where they are, you combine that with the multiple news articles you can read every day about the amount of cash sitting on the sidelines, waiting for deals, waiting for this distressed real estate to come available. And I think it's very unlikely that you're going to see a large spike in cap rates. And the reason for that is that there's really nowhere else for this money to find good yield. It's hard to invest it in debt right now that's going to do that for you. Government debt basically pays nothing. There's specialty debt and hard money and stuff like that, but there's not huge amounts of funds chasing that. I think if cap rates were to start rising significantly at all, the amount of cash that's going to come in off the sidelines is so huge, it's going to keep cap rates relatively compressed as we move forward and the economy figures out our way out of this thing. And I'm interested with everyone else's opinion on that as well, but I just don't see a way for us to have this repeat performance with where people's equity positions are as well. The second side to my prediction there is what happened here in 2008 through 2011 is going to do us a huge favor on the way out of the COVID crash, or the COVID economic crash, so to speak, right? Ever since this went down, we had a string of legislations. We had banks with super conservative underwriting, and there is really no way you can buy a property unless you're buying with FHA-backed loans, which are insured, or Fannie and Freddie products with low money down. if you're buying apartment buildings, you're putting 25% minimum, often 30, 35, 40% down to buy buildings. And these buildings have tons of equity, so you're not going to see people walking away from them. They could lose that much value from where we are right now, and you still wouldn't find distressed sales as long as the tenants are paying the rent. Combine that with the fact that if right here, when we passed our previous high in 2016, the rents in 2016 were about double what they were in 2007. So the underlying value of the asset is much stronger now than it was here. People were buying stuff at the same prices that generated half the rent. So if you think about what's going on in the market right now, tons of equity, strong fundamentals, almost no supply on the rental side, just like in the single family housing side. We just haven't been building enough, especially if you're buying B and C properties for working class folks. The developers really, it's difficult to pencil building that stuff at all. It's been mostly high-end build on this cycle. It's going to be really, really difficult to see serious distress and pricing pressure on B and C multifamily, which is our main stuff, going into this cycle. The Class A stuff, I'm a little bit more skeptical about. If you look at articles out there right now, you can read a lot about asking rents going way down this year, about cap rates rising, but that's on an overall basis for the whole market. That includes a whole bunch of newly delivered units that are in this like super high-end space, one bedroom units like above 3,000, above 4,000 in some cases. And that skews our numbers to make it look like that's happening throughout the entire market when that's not necessarily the case. So kind of anybody's guess on where that might be, but it's a really interesting situation that we're in right now. So that's basically the data. Yeah, go ahead.
Do you track rents? Do you have trends on rents over the last, how many years?
Yeah, so we do that locally. So let's look at like Long Beach. CoStar rents are not good at all. Their data is no good. And my internet connection's bad. This is a great website to use, by the way. Super cheap for the pro version. And look at rents. So here's just a few years of rent data going back on a one bed.
Anthony, you're breaking up. We're losing
our Long Beach office in 2017. All right, I'm going to stop the share. Can you hear me now?
Yeah, that's better. Yeah.
Okay. I think my internet connection is no good. So yeah, we have more trended rent data that's longer than the Renometer stuff as well. Rents, even in 2008, barely went down in California. They went down a little bit, less than 5%. And I think that's mainly because a lot of people were moving out of homes back into rentals that shouldn't have been homeowners to begin with. So the rents are the big question for a lot of multifamily investors moving forward, because they're so much higher than they were in the last cycle. A lot of people are wondering, where can they go from now? And I think it is definitely a case of different tranches of building quality, Class A, Class B, Class C, where are the rents going there? I'm really comfortable investing in lower income, working class type units. There's really nowhere else for those people to go other than moving way out into the middle of nowhere, or even to another state, which is also in the headlines a lot right now. They've got to rent some of these units. I mean, we've got, one beds in a lot of our areas are, $1,300-1,400 bucks. There's nowhere else to go. So I think that's probably the best place to be. And that will trickle down as the Class A stuff starts to have trouble, if it does. But it'll be really interesting to see where that goes. Rents basically have never meaningfully gone down over those 50 years. I mean, when you get that cycle, they kind of level off, barely go down, and continue to go up. I would be really surprised to see multifamily rents drop in a meaningful way. But this cycle has been an exception to the past and that rents have really exploded. So it's going to be interesting to see how that goes. I think on the migration question, it's an interesting one as well, because on one hand, we have out migration from people at the bottom end of the price spectrum moving to other cities, other states. That's been a popular topic. On the other hand, there's a lot of higher skilled labor moving into these tech markets that can afford these units. And so we're sort of trading people at different income levels. And I think there's possibility that that's going to allow the rents to continue to rise as we sort of trade demographics with other parts of the country. But great question. So I can take other questions on multifamily. Let's see what's in the Q&A. Okay, we talked about the freeze on evictions and mortgage forbearance. Does the cost per unit matter for 5 or let's say 20 units? Is this across all doors sold? Cost per unit's a good thing to look at, but I honestly think people focus on that too much in multifamily. You know, especially in our market, we've got a lot of units that are tiny little studio units, 400 square feet. And then you have big 2-bedroom units that are more like 800 square feet. And when people just say cost per door, those aren't comps between each other. So I'm not a huge fan of that metric in general. I know that's what people use kind of across the country. It's a popular metric just to talk about what's cost per door there. But if I don't know, you know, what unit type you're talking about, it's kind of a meaningless metric for me. You know, I have like some of these 1920s courtyard buildings that have 10 or 12 units, these tiny studios, and those will go for, you know, 140, 150 a door. And then a regular 2-bed unit in the same neighborhood is going to go for 300 a door. So it's a useful metric to look at overall stuff on. And I think it can be a good indicator of upside in a building. If you've got a really low cost per door that relative to the market, that's an indicator that you might be able to be aggressive on the rents relative to what you're seeing everywhere else. So if your GRM and your cap rate are the same, but you have a low cost per unit relative to real comps, that can be a good comparison metric. But it doesn't make sense to look at that alone without paying attention to the income metrics. The income metrics are definitely more important. And the cost per door question is more important as you get into larger buildings as well. Let's see, can I explain again how what happened in the 80s with inflation might happen in the next few years? What are the implications for real estate? Well, I mean, we pumped trillions of dollars into the economy right now. So generally speaking, when you do that, a lot of people think that there's going to be a ton of inflation. You add a lot of supply and prices tend to go up over the long run. Now, right now, it seems like we might even be in a deflationary period in the short run because the ability to spend has been extremely limited. Everybody's staying at home. We can't do much, and that may happen in the short run. But what happens with inflation, if inflation comes back aggressively, and you think about pricing on these buildings, and you think about that 50-year chart, here's what goes on. Let me do another share. So if you're borrowing 75% of a building's purchase price, say you buy $1 million building and you borrow 75%, you borrow 750 grand, you put in 250, and inflation goes wild and your building goes up 400%. And I'm not saying that's going to happen because I don't think it will, but just, it's a hilarious example. So let's say the price goes up by 400%. You now have a $4 million building and a $750,000 loan. So that's why inflation can be an incredible thing for real estate, because your building follows the prices in the economy as they go up without you having to make up for that in income by, say, asking for raises from your job, making sure you're invested in the right company that's going to stay in business during that time period. And on top of that, rents are likely to do the same thing along with prices in the economy. So while your rents are going up and the value of your property is going up, the relative value of your loan to the value of the property is eroding very, very quickly. So if that happens, and this is a really interesting idea, and we look at these market studies again, you could have cap rates and gross rent multipliers stay totally unchanged. That's a relationship between the rent and the price of the building. If rents and the building prices are going up at the same rate of inflation, and that's fast, you could have extreme appreciation. You'll see higher price per square foot and higher price per door, but these numbers could remain totally unchanged as that goes on. So people focus only on cap rate compression or GRMs changing. That's not the complete picture. You have to look at all these metrics and their relationship to each other. And we haven't had that happening in this country for so long. A lot of people aren't used to thinking about things that way. Now, I don't think we're going to have a 400% increase in values, but that's what happens when inflation takes off. And that's why owning any kind of real estate is so strong when that's going on. So hopefully that makes sense. All right, let's see if we have any other questions. Erwin's gone dark on us. And it's his turn.
Oh, no, I'm back.
Okay, good. So I'm going to turn it over to Erwin. The moment everyone's been waiting for, to hear about what the heck is going on with retail. And if you do have stuff to share, you can screen share, or you can just give us the latest, because I know it's changing on a minute by minute basis.
Yeah, so I appreciate the opportunity to be here. Thank you, Anthony, and it's been informative for me to hear you and David speak. And I think the biggest lesson as I listen to both of you is really you got to look at the microeconomics of every real estate asset and not look at macro. You need to look at macroeconomics, but micro is more important. So retail is a space that I've been in for the last 25 years. By way of background, I'm a partner in a small company in El Segundo called Paragon Commercial Group, and we develop, own, and manage grocery-anchored shopping centers primarily throughout the state of California. CalPERS, which is the Public Employees Retirement System, is one of our equity partners. And retail has had quite a run over the last 10 years. It's been, to say the least, amazing. We were buying properties during the last downturn for $100 to $150 a foot, and then flipping them anywhere from $250 all the way up to $350 a foot. Now, and getting back to microeconomics, retail is pretty simple. Sales drive rents. So if we don't have sales, guess what? Rents are going down. Right now, we're facing record unemployment. PPP funds are expiring. These phased reopenings are really having a huge impact on all sorts of operators. The consumer psychology is changing as well. And perfect examples is my wife and my family. We're ordering more groceries online than we ever have, and it's just going to continue to do so. Online growth has grown roughly 30% due to COVID, which is huge. And you need to think about brick and mortar retail as distribution points. So, a lot of the assets that we bought were with tenants that you would say, oh my God, why'd you buy this? We bought a couple Toys R Us properties, and one of the leases was signed in 1974. Well, that lease rate was extremely low per square foot. And our goal when we bought the property was hopefully Toys R Us is going to go out of business and we're going to be able to recapture the space. And we did recapture the space, and we doubled our rent on that particular space, which was 35,000 feet. So, let's just say it's 30,000 feet at double your rent from $15 to $30 a foot. That's 450,000. Take that at a 5 cap in terms of your cap rate. That's roughly $9 million in additional incremental value that you added. Now, naturally, there's costs to get there in terms of TIs and commissions and downtime and all that. But the space itself is really going through I would say, renaissance and rebirth. Things that are here to stay. To give you an example, we had a discussion with a publicly traded grocer, and one of our friends went to work there as the director of real estate. And this was right after COVID hit. And we asked him, how's it going? He said, every day is Thanksgiving. We are doing so well. And that's continuing too. I was just in Trader Joe's last week, and I was talking to the cashier and asked him, they are still 50% above sales in terms of pro forma. So There are a lot of headwinds, though. So there's a lot of bad news. All you have to do is turn on the TV. I mean, the amount of bankruptcies that we've had, from JCPenney to 24 Hour Fitness, to Ascena, who owns Ann Taylor. They filed today. You've had significant issues with bankruptcies, which means there's going to be a ton of supply hitting the market. Well, with the ton of supply and less retailers, what's going to happen? Rents are going to go down. So you may ask, you may say, well, you got all these negative things happening. What are the good things that are happening? Well, the good things are the grocery store space is continuing to grow. There's aggressive expansion by Amazon. There's aggressive expansion by Aldi, Sprouts, Target, Whole Foods. A lot of players looking to enter that space. And where do they want to be? They want to be in the dense, high barrier to entry markets, and really to capture that market share. So we're going to see a lot of bankruptcies. And give you an example, we own an Office Depot on Sepulveda by the LA airport, and we were able to come to a lease termination with Office Depot, and we're backfilling that with Target. And that's so your credit quality increases, you've got a brand new, fresh new lease term, higher rent, so there's value creation there. You're going to see more of that. So strategically, what we're looking to do is really position ourselves with the best-in-class grocers to identify opportunities. Drive-throughs are, think about the value of a drive-through today. And Anthony and I are on a LMU real estate committee, and the director of real estate for Wendy's was there, and we were asking her how are things going post-COVID, and her comment was the amount of business that's going through the drive-through is roughly 40% higher, and a lot of the operators don't even want to open up the dining room anymore because there's too much labor costs. They just want to essentially have the drive-throughs operating. Home improvement, because people are at home, that continues to grow, and people are now spending a lot more on gardening, on different things like that. So that's here to stay. You're going to see a huge increase just with aging demographics as well in terms of the medical space. But shop space is scary, all right? And we've got a portfolio of roughly, I'd say, 15 properties. I wouldn't say a lot of shop space. I'd say 20% of the portfolio is shop space. Some of that is with credit, and some with mom and pops. Mom and pops are really having a tough time, just given the stay-at-home orders. The PPP funding has helped, but once that goes away, that's going to be difficult. We have a restaurant, and to give you an order of magnitude, we have a restaurant in one of our shopping centers. Their monthly sales were roughly $130,000 per month pre-COVID, and post-COVID, it's down to 70. Okay, they don't have a drive-through, so that's going to be hugely impactful. So where do I see things going? Well, price per square foot of real estate is definitely going down. Lenders are on the sideline. Retail is a bad word right now, but I can tell you that's when there's going to be some amazing buying opportunities. And there's definitely going to be shopping centers are going to be smaller. They're going to be less shop space. Infill locations are going to continue to thrive. And we've got something we're working on. It's going to take 14 months to get it entitled, okay, to get the approvals to get a grocery store with a conditional use permit for the sale of alcohol. And a lot of people say, well, wait a second, I can just buy an apartment building. I get cash flow and rent. Well, why would you do that? Well, bottom line is returns, the returns make sense, and the credit quality of that income stream is very desirable when it's all said and done. And there continues to be strong demand for single tenant, credit-worthy tenants. foreign capital is really, at this point, disappeared. We had a lot of buyers that jumped from the apartment space into retail. I can tell you right now, they're probably wishing they didn't do that. So you're going to see, I think, more activity. We always like to buy property next to the malls. Okay, so we're mall adjacent. We like to be across the street from the mall, but not at the mall. And the reason being is we've got lower operating costs to operate the property, and it's more attractive in terms of field of parking, and we can feed off the mall, yet not be at the mall. And we're going to continue to focus in on that. A little bit about Paragon. We started at the company at the last cycle, so we've been involved, and I think this is my fourth cycle. And I kept telling people probably 6 months ago, I'm waiting for the next cycle because I finally have capital and I finally have equity, and I want to buy a lot. Well, I think we're going to buy a lot, but it's going to be very, very selective. We have 3 deals under contract right now, all grocery with a grocer in tow, all infill locations. Leases will be signed prior to closing. So there is activity, but the biggest thing is to really understand that cash flow and understand that NOI. And how do you, in other words, if you got 10,000 square feet of shops, how do you forecast that NOI? Well, rents are dropping, and quite frankly, there's going to be a lot of people that go out of business. So in our business, we make money when tenants don't leave, and they continue to renew, and there's continued rent growth. And that's what we're looking for. The forecast, the average price per square foot in the last 12 months was around $430 a foot. They are forecasting roughly $300 a foot. I think the space is going to be smaller. There's going to be less people that are in the space because you've got to have the relationships to, in other words, create value. And when I talk about relationships, that's really with the anchor tenants. My background, I worked I was in brokerage, worked for a small developer. Then I went to work for a publicly traded REIT for 11 years, and then Foreign Paragon about 10 years ago. So we've got a good flavor on the entrepreneurial side as well as the institutional side. And it's going to be interesting times, but it's going to be a bumpy road. So happy to answer any questions.
Wow, wild world. What do you think if an individual investor or small group were looking to get into retail, is there opportunity there right now? It seems like you have great relationships with some of these really, high credit tenants that want to be a part of your projects. Is this something worth looking into for individuals, or is it a really tough space out there right now?
One of the things about me is I love real estate, and whether it's apartments, whether it's houses, whether it's office, or whether it's retail, and I constantly drive markets to understand the microeconomics going in that market. And I can't tell you how many times I'm driving with my wife and I stop and she goes, what are you stopping for? I'm like, because that building is now vacant. And guess what? There's a play there. So yeah, there's absolutely know your market. There's absolutely opportunities out there. I think the tenant relationships are key. But think about one of the things that I always look at is think about like the Greek burger operators. Okay. And there's a lot of them out there. They own some amazing real estate with drive-thrus, right? There's huge value there. And you look at Chick-fil-A and you look at In-N-Out and you look at Raising Cane's. I mean, back in the day, ground rents were about 120 to 150,000 in ground rent. Now, Chick-fil-A and Raising Cane's, they're paying anywhere from, $250,000 to $450,000 in ground rent. Okay. So, and that's drugstore ground rents because they're doing so much volume out of there and they're making so much profit. So, there's there's opportunity. You just need to figure out. It's like chess pieces, right? And that's the great thing about retail. It's always changing. Tenants prototypes. All of a sudden, they want to be, instead of 25,000 feet, they want to be 15,000 feet. Well, if you can get that 25,000 square foot space back, release it to a grocer, and relocate that tenant, well, guess what? It's a win. The mall space is super, super scary right now. Our rent collections overall were about 80%. I think they're going to dip a little bit unless we get some more help from the government. But that is primarily because most of our stuff, the primary income stream is the grocer. But overall, the malls, some are at 25%. So think about that. If you owned a mall and you're only getting 25% of the income stream, and there's co-tenancy clauses, there's all sorts of evils within retail, and it's something. The reason I like grocery is everybody needs food, just like Anthony and David said. Everybody needs a place to live, okay, and everybody needs to get food, and also trips per week to a grocer are higher than a trip to a mall. So if you have more trips per week to a grocery store, that means you're going to have higher rent growth with the shop space.
Erwin, what's financing like in your world these days? Or and in particular, how are lenders looking at like vacancies and how long it's going to take to get them filled?
I think lenders. Here's the good news about our platform. We've got a relationship lender. We don't have CMBS debt. We have life company debt on one property, but it's single tenant with a great, with credit behind it. So there's that tenant is continuing to pay, which is great. But lenders are really looking at the operators and saying, do they have an expertise to figure out these problems and figure out solutions? I can tell you that I'm in every city that I operate in. I'm calling them and saying, guys and gals, you really need to look at your land use right now, because you need to have a competitive advantage over your neighbor. And you got to start looking at what other uses can I allow at this shopping center? Because quite frankly, the U.S. is over retail. We've got too much retail, and there's going to be a change of uses into a lot of the retail centers that you see today, whether it goes mixed use, whether it goes medical. There's distribution facilities as well. There's Amazon just took the old Costco in Torrance at Lameda and Crenshaw, and they're going to be doing a distribution facility out of there, which is, and think about it, all of a sudden they get, the hub and spoke, they get the ability to serve that huge consumer base just by having that distribution facility there. So change is constant, and I think as real estate professionals, change is, thank God there's change, right? Because that promotes activity, it promotes opportunity, and I just think there's going to be great opportunities, but you got to be careful.
Awesome. David Schultes had a question. If you expect a peak in business bankruptcies, and if so, when that might occur?
Well, I can tell you probably, probably 18 years ago, I bought a Kmart, okay? And with the assumption that Kmart is going to be gone, I had a Home Depot deal lined up to take Kmart, and Kmart wouldn't go. And I offered them a big sum of money. They wouldn't go. And anyways, long story short, there's been a lot of retailers that shouldn't have been in the space. They're owned by private equity. Albertsons, just think of Albertsons right now. They just went public. They've been trying to go public for the last probably, 10 years. And what happened was, because of the pandemic, because of COVID sales, their sales have grown significantly, and that allowed them to go public. Private equity in retail it's a tough sword, because those companies are looking to really get as much value out of the company and then throw it into BK. And it's happened time and time again, whether, it's Toys R Us with Vornado, whether, there's so many private equity companies that have done that. So it's still murky, the water, and there's not a flood of properties on the market. We're getting a lot of calls where owners are saying, hey, I'm getting a little concerned, but I had this offer in, October of 2019, which was, 25 million. Well, guess what? That thing's probably worth, 18, right? I mean, so there's got to be a realization of the decrease in value. And again, if I go back to my first comment, which is sales drive rents, if sales are decreasing, and think about all the operational costs too for the retailer, for installing plexiglass, for putting markings on the floor, for security, for all these different things on their operating costs just to operate their store. If they're open for business, right? That really has an impact on the overall bottom line. So I see retail rents going down, except in super high barrier to entry markets where it's very difficult for someone to penetrate and get into that market, and they know that, and there's not a lot of opportunities. I've worked on a lot of assemblages where I've done 7 parcel assemblages where you got to buy 7 parcels, close at the same time, get entitlements, get this lease on. They're a headache, but bottom line is there's huge demand by the retailers because they want to penetrate those markets. So bankruptcy wise, I think we still got a lot more to go. But I don't see it in my space. I don't see it in the grocery space. I see it, in debt. There's going to be a lot more mall bankruptcy tenants. I think that, office supplies, when the pandemic hit, office supply sales were through the roof because everybody was coming home. They were buying printers. They were buying screens, all this stuff. Well, now they're all set up. So those sales have decreased. And we'll see what happens there. So but I can tell you this, I've never had a day in retail where I'm like, okay, I don't have to think about the next chapter. The next chapter is being written right this minute. And I do my best to try to figure out what that is. And typically I'm so far off, but it's always changing. It's always changing.
Well, I think you've done more than okay so far. What about, I think they named it Prop 15, the commercial property tax split roll initiative. What do you think about that? Where's it going?
Well, did you hear about AB? Was AB 39?
Yes, 939.
Yeah, Assembly Bill. Yeah, 939 exactly.
Yeah.
And that one was any tenant could renegotiate if they didn't like the terms. They could terminate their lease.
Right.
Oh my God. And thank God that didn't get approved, right? And ICSE, which is in other words, our trade association, along with every retail landlord, really had a discussion. Now, it didn't apply to public companies, but think about this. One of my friends owns a number of tire facilities. Well, this tire operator is one of the largest tire operators out there. They have a bigger net worth than a lot of the public companies. Under that Assembly Bill 939, they could have terminated those leases. Okay, and what happens? The bank takes it back. It was not thought out. Now, Prop 13 repeal would have a huge negative impact on our industry because, again, those tenants, they pay the property taxes, the insurance, and the maintenance. It's a triple net lease. Okay, right. And once again, occupancy costs are key. They're looking at overall occupancy costs. So, that would be terrible if that happens. And, there was also some discussion that if Biden gets elected, he's going to eliminate 1031 exchanges.
heard that one. Yeah.
Yeah, think about that. That's absolutely, nobody's going to sell their property. It's going to be deferred maintenance. Nobody's going to invest capital into the property. It's. I'm not sure where these people are getting these ideas, but that's my opinion, by the way. So
I don't know. Hopefully it doesn't happen.
yeah.
What do you think is the future for malls?
I think it's a lot of mixed use. I think there's more residential. I mean, typically they're very well located. They're in great trade areas. Some of these J.C. Penney going bankrupt. Well, guess what? A lot of those anchor tenants had consent rights on all the redevelopment on the entire property. Okay, so you couldn't add residential without their consent. Well, if you want to add residential, they wanted to check. Them going bankrupt, rejecting that lease, if they're out of the way, it's going to make it easier. Now, the reality is you still have a lot of other players that are involved, but it's still going to be difficult. I heard a metric that all the anchor department stores only pay 15% of the rent at a mall. Okay, so you're thinking, well, wait a second, that to me, if I hear that, I'm like, well, the metrics on that's great. There's upside in that. There's not, because the conversion costs of those anchor boxes, because there's no more 100,000 square foot tenants. Okay, besides Home Depot and Lowe's. Target's not doing it. Walmart's on ice. They're not doing it. Everybody's investing in really their digital platform. And Target's doing smaller stores to penetrate high barrier to entry markets. So, yeah, I think the mall space is going to be tough, but I do think, CEQA, honestly, in my opinion, and that's the California Environmental Quality Act, I really think that needs to be reformed significantly because, as I said, one of the projects I'm working on, it's 14 months for a grocery store, okay, for an essential retailer to get entitled. How does that make sense? It doesn't.
Try building a house.
Yeah, exactly. Exactly. It's tough. Wow. Happy to answer any other questions.
Fascinating stuff. What do you think about some of these, smaller little like neighborhood strip centers that you see up and down PCH on the entire coast of California? Are those going the way of the dodo bird, or there's so many mom and pop businesses in those spaces, and it seems like they're so easy to blow by in your car? And what's going to happen there?
I think it's a tough space. I really do. And one of my coworkers made a point probably a year ago. He's like, that is non-institutionally controlled, right? So there's no institutions controlling those. You got great rent growth, older stock, infill locations. That should be a target. Well, with COVID, part of the problem, a lot of these businesses are operating on a shoestring budget as well. We've done deferments through this crisis with some of our tenants, and dollars to donuts, I'm not sure if I'm going to get that money back. So, right. Oh yeah, I think it's tough. I think I keep seeing a lot of high density vertical projects, mixed use projects going in on those sites as well. I think that's going to continue.
That seems to make more sense to me. Yeah. Awesome. All right. Well, anybody have any other last minute questions? Put them in. We're getting close to 9. I know it's been a long and interesting evening of market updates. We post the videos for all these talks on the Buckingham Investments website. So check that out. Should be the first result on Google if you type it in. And a huge thank you and round of applause to Erwin and Dave for joining us tonight and sharing your expertise. Thank you so much, guys. This has been really great, really interesting for me. And I know we're all watching this stuff every day to see, guessing what might happen in the future. So thank you so much for joining us. Maybe final words from each of you and we'll sign off.
Thanks for having me. It's been a pleasure. So I appreciate the opportunity, and I think the only thing I can say is this: real estate, think about owning, and I got a project approved in Hermosa Beach, and it was we had to pay $70 a foot for the land. And everybody was like, oh my God, that's insane. It's so expensive. It's not. Real estate is one of the best investments long-term you could ever make. And it's a great space to be in.
Awesome. Dave, final words?
Yeah, first of all, Erwin, they're asking for your email address, so make sure you put it in the chat. No, it's been great. Thanks for the invitation. I say we do it again in a year. Let's see how right or wrong we were.
I was going to say, we should do this every 6 months, maybe, on this group. Things are changing so quickly right now. And I know, the direction of the market and market data is always a question from everyone. So maybe we'll do mid-year and year-end and do this twice a year. That would be interesting if people are up for that kind of thing. I love this stuff. I love market data because it's the only thing that actually you can look at and try and make sense of what might be happening in the future. All right. So we will go ahead and adjourn for the evening. There's Erwin's email. If you guys want to reach out, thank you so much to the pros here for joining us and volunteering your time on a Thursday night. Hopefully we see everyone next month. We'll have an awesome topic out shortly, and everybody have a great night.
Thank you very much.
Bye.